Welcome to Hedge Interview, the essential listen for private fund managers committed to operational excellence. This episode provides an inside look at the manager due diligence and selection process at Longwall Investment Partners, a multifamily office located in Lake Forest, Illinois, and Westport, Connecticut. My guest today is Terry Purcell. He is a partner and co-chief investment officer at Longwall, where he applies 3 decades of experience in direct investing, allocating, and consulting in alternative and traditional investments across private and public sectors. Terry has also been the head of portfolio management at a $20 billion fund of funds, and he oversaw private equity and alternative investments at a $45 billion Connecticut pension fund. Thank you for joining me today, Terry.
Thanks for having me.
So tell me first about your experience at Longwall.
Sure, Jennifer, thank you. Longwall is a multifamily office focused on investments. It started as a single family office about 3 years ago. We're growing. We have a handful of families now. We're expecting to onboard a few more in the coming quarters. And we have a small team, but a very experienced team that has a lot of experience, particularly in alternative investments, which we think is a differentiating factor from a lot of other small family offices and wealth management groups. So things are going quite well, and we're growing.
And how about your prior experience? You have extensive experience in the private fund
Sure.
management world. So tell us about that.
Sure. I've been on the buy side pretty much my entire career. I've been an career-long investment management person. Started as a fundamental analyst at Mitchell Hutchins, which was Paine-Webber's asset management company. Ended up running 2 hedge funds. Got started really in the hedge fund space, the alternative investment space, in the late 90s. So it's been quite a while. Ran 2. Ended up transitioning to being an allocator about 12 years ago now. So I was appointed to the position you mentioned at Connecticut's pension fund in 2012. And it was a phenomenal role that included not only overseeing hedge fund investments, but also, as you mentioned, private equity, venture capital, real assets, opportunistic. It was really multifaceted. It was a wonderful position, and that's an office that's still near and dear to my heart. And then I went to Purcell, as you mentioned, which was $20 billion fund of funds, predominantly hedge fund of funds, and I sat on the global investment committee. So I guess at that point, I had a lot of hedge fund experience. So it's logical that it is one of the focus areas or the building blocks for the investment process we have at Longwall.
And you've seen the whole, fund management industry evolve over time. So what would you say is different today than what it was 10 or 20 years ago?
Sure. I think the financial crisis in '08 had a big impact. I think that it caused a lot of pressure, particularly in the hedge fund industry, to kind of institutionalize. And there were good aspects and bad aspects to it. I think that the most significant change, though, is it really kind of brought in risk-taking or reduced risk-taking for a lot of managers. And that's not necessarily positive for an allocator. You want your managers to be basically pursuing the investment strategy that they've done well for a long time. On the flip side, the changes in the pressure increased transparency in the industry. So that's a very good thing for allocators, obviously, to have a much better sense of what managers are doing and what are in the portfolios.
And how about your manager qualification process? Is that similar to the process that you used when you were at the fund of funds, or has that evolved as well?
No, it's a great question. It hasn't changed a great deal. My personal bent and ours collectively at Longwall is for managers with significant experience. In some cases, that might be a manager that has run their hedge fund firm for 10 to 15 years. In some cases, it may be a fairly new firm. It could be an emerging manager. But in that case, really, what we want to see is obviously good transparency of the manager, his or her results from, wherever they came from, the shop they were last at, and obviously are looking for managers that are pursuing the same strategy that they were doing then and did quite well. So, we can do both, but they do tend to be managers that have, a fair amount of experience.
So,
Sorry, go ahead.
so for emerging managers, what would pique your interest? What are the elements that get you excited about an emerging manager?
Well, I mean, I've always been partial to emerging managers. A lot of great performance, obviously, as you know, comes early in a fund's life cycle. So if you look across the roster of managers at Longwall, you're not going to see any really large hedge funds. There are cases where size does become the enemy of performance. So there's nothing wrong with being an emerging manager, but the kind of things that we would look for have to do, in addition to track record verification I just mentioned, have to do with the business that they're setting up. And so we would want to see really well-known service providers that they have hired, whether it be prime broker, the administrator, the legal counsel, et cetera. And we can know really quickly by looking at those names, if they're names we know or not. Also want to look at the internal infrastructure that is being put in place at the fund manager in terms of both people and the appropriate investments in technology. It's important to us, it won't surprise you that we want the manager to have a significant percentage of their liquid net worth in the fund. We want our clients to truly have alignment of interest with the managers that they're invested with and be investing alongside them. So that's very important to us. You would find that at all of our managers, and they're just a few. I can go into more, but they're kind of right off the bat. You really need to check those boxes for us to I think proceed with due diligence.
And do you expect a fee structure that's more palatable given that they're less experienced, that they have less of a track record? I've been seeing that myself more often, so I'm wondering if that's your experience as well.
I think we've been seeing a little bit of fee compression. I would say we don't lead with it. You want to see standard terms, and frankly, I think a lot of large allocators, and we were this way at Connecticut when I was there. Want to back our emerging managers and understand that they have to pay their people. They have to turn the lights on before the assets reach a certain size. So we're not really, outside of maybe a seeding model or something like that. I don't think there's a lot of pressure on emerging managers, or should be a lot of pressure on emerging managers to cut fees. Later on in the life cycle, yes, then I think we could talk about it. I personally particularly seen it a lot on the private equity side, where when a fund reaches Fund 5, Fund 6 vintage, and they've raised billions and billions, you may see some fee reductions. But it's not something we'd lead with at all for an emerging manager to over focus on fees. We want to know what the net returns that you deliver for our clients are going to be.
Right. And how do you source managers, emerging or established?
Multiple ways. We each have internally, as I've mentioned, a long history of vetting managers. So there's pre-existing body of managers that we know. We do speak with prime brokers. We go to what we consider are the most important couple prime broker capital introduction conferences that happen each year.
And what are those? Wait, what are those?
Well, I mean, I personally spent time in January at iConnections down in Florida for the first time.
That's a good one.
Which is a high volume, opportunity to see managers of a lot of different strategies.
Mm-hmm.
We're fortunate to have good relationships with both Goldman Sachs and Morgan Stanley, who run great conferences each year. Some of them locally to us here, so it's convenient. So when I'm going back to the comments I made about being with really top tier service providers, obviously those are, and if you see a manager that's using managers like that and a few others, as their prime broker, it gives some comfort certainly versus a manager that's using a prime that you never heard of.
Right, right. And what's your typical allocation size?
I think, I think our largest right now to a single fund is somewhere between 5 and 10 million, but we've typically started at about $2 million. And, that's obviously now growing and going to grow as Longwall grows. So it's not terribly significant, but, we're with managers that are, in many cases, 300, 500, $700 million in assets across the firm, where they're, a phenomenal manager who, in addition to having a majority of his or her net worth in the fund, is also not spending a ton of time out on the road marketing. So, these are not, like I mentioned, the really big shops. These are more, funds that in a lot of cases, you probably haven't heard of. So we're not an insignificant investor, and hopefully we're going to get bigger with them as we grow.
Mm-hmm. And is there an AUM size that is sort of like a bare minimum that you require for an emerging manager?
It's not a hard and fast one. Obviously, when you get to 100 and some million dollars, that's when you register with the SEC. That's obviously a nice checkbox or a nice milestone. We at Longwall registered with the SEC last year, and so that's helpful. But no, I don't think there's really, a hard and fast threshold. You have to look fund by fund at the liquidity of the strategy and what the capacity is, and you have to think about a lot of different variables in terms of finding an ideal AUM size. More importantly, I think I'd advise emerging managers to spend a lot of time on their DDQs. That's a really important aspect, particularly for smaller managers. We get a ton of information there, particularly about the operations and mechanical things that are outside the investment process, like money movements and service providers and policies and procedures that have been put in place. We spend a ton of time combing through DDQs of managers that we're seriously vetting. So I would recommend taking that component of it very seriously.
At what stage do you look at the DDQ? Do you request it?
When we're significantly considering it, we will have met with the manager certainly at least once, probably multiple times. Possibly have seen a general presentation they've made at a conference. In certain cases, we've looked at managers that had been working with one of the top tier placement agents in the country. So we know in those cases that a lot of operational due diligence has been done. We know somebody else is vetting this manager alongside us. So, right away that placement agent would give us the DDQ and all the materials. So, it's stage 2 or stage 3. Obviously, it starts with looking at the marketing materials, better known as the deck. And, it's important to have a good deck. But we will focus again on kind of the track record, the history, the consistency of how the investment strategy has been managed by that manager.
And how long do you look at a manager before you allocate? What's your sort of life cycle of evaluation?
Sure. We're only a 3-year-old firm, so I don't want to generalize too much, but it's significant. We pride ourselves on being fundamental analysts, and we do the research. So we spend time with the manager before committing, our family clients' money. So there's never been an investment we've made that was shorter than a few months, certainly in duration. And we're invested with several managers that my partner's known for many years, and the due diligence started 5-7 years ago. But we at Longwall didn't make our first investment in them until mid 22.
Mm-hmm, mm-hmm. And are there specific strategies that you like more than others?
I wouldn't say that. I think that, that changes with the market environment. Alongside running our clients' portfolios and customizing our clients' portfolios, we also have started a small internal hedge fund of funds. So we have multiple places that we can use a hedge fund manager in our broader investment portfolio. If you look at that fund of funds, we have a variety of strategies. We have several equity strategies, but you really wouldn't find any of them being just a plain vanilla long short equity manager that does every single sector. We tend to like specialists. It could be a sector specialist, a single sector, or maybe 2 to 3. And then we have non-equity strategies alongside that. We love uncorrelated managers. If you look at that portfolio, we not only have managers who are uncorrelated to public markets, but managers who are highly uncorrelated to each other. We've invested in an agricultural commodity specialist. We've invested with an emerging manager rates specialist. Again, we have a specialized Asian manager. We invested with a healthcare sector specialist. So they don't correlate with each other, and that's a good thing. So it really depends on what you're seeing in the environment, but they tend to have, even if they're not pure sector specialists, they tend to have a very tight investment focus, and they are not go anywhere strategies. We know exactly what they're doing. It's in our view a repeatable strategy, and if a client asked me or my partner what a particular manager that we invested with does, we know that we can answer that in 15 seconds, and we should be able to. So if it's a strategy we don't really understand, or we don't see the consistency of the returns in the past, it's probably not a manager that we would continue betting.
Are you considering any sort of new areas like blockchain, digital assets, AI, the new kids on the block?
Well, we're a small firm, so we're not doing a ton yet in the digital space, but kind of everybody's doing AI, right? So AI is touching everything at the moment. We're not necessarily looking at managers or specializing in it, but we're spending a lot of time with managers that are educating us as to how it's going to impact their companies. And so we have investments with managers who are both long and short kind of companies that will be affected by AI, both beneficiaries and potential losers. So it's absolutely a pervasive theme. Obviously, one of the other things that's changed in the last 2 years, along with AI, has been the interest rate cycle. So for 15 years, you didn't really have to think a ton about fixed income with rates near zero, but that changed in a hurry, obviously. So spent a lot of time in the last 18 to 21 months with credit managers and understanding how they manage, particularly long short credit managers. And I think our house view would be that rates are not going back to that zero neighborhood anytime soon. So these opportunities to profit in credit, particularly from dispersion in credit products, will persist for a while.
Right. And so for managers that are looking to sort of get in front of you, would they be better served to go, to try to get in front of placement agents or prime brokerage first?
No, when I mentioned the placement agent issue, that was happenstance in a couple of cases. We source most directly. Most do not work with a placement agent. And like I said, we're at conferences. We are, included on a lot of companies, firms, marketing distribution lists. We have prior relationships, like I mentioned. So there's a variety of ways, but I think that, the best way tends to be to reach out directly to allocators such as us. And I think the most effective, way to stand out is to pretty quickly be able to espouse the differentiators in your investment strategy. You see a lot of long short equity. So, that's harder to right away be able to say,
Hmm.
here's how this manager's different than the last 10 we've seen. So, particularly somebody like us that loves kind of tight investment processes, if not sector specialists, it's really, beneficial to be able to espouse your differentiators right up front so that you stand out from the pile of decks and can, we continue on looking at you.
That's, I'm glad you said it because I tell managers that all the time. Right.
It is what it is. There's a lot. A typical allocator obviously will not end up allocating to the vast majority of funds, external fund managers that they look at. So, it's really important to kind of put a thought in the allocator's head early on as to what your position would be in that allocator's portfolio.
Right. And so what are some mistakes, like a no-no, like common mistakes that you see that are just like, that's a no?
Doing the other side of the things I've just mentioned, we tend to focus on. So, consistency of the application of the strategy, very key. So, if we see a manager that is succumbing to that age-old term style drift,
Mhm.
that's immediately going to raise flags. We're going to dig into that. That's really never a positive. I would rather a manager that consistently applies their investment strategy across environments. Obviously, they want to adapt. My partner and I spoke just yesterday afternoon on a video call with one of the managers we've invested in. We catch up, very frequently, periodically, and really, he was able to espouse to us his views on the market right now, his views on what's going on economically in terms of the uncertainty over inflation and interest rates, um, changes he's made in the portfolio. So when we hung up the call, we had a very good sense of how he was positioned, how he was thinking. And it's a difficult environment right now, but he's doing the same thing he was doing last year, 3 years ago, 5 years ago, in terms of his core investment strategy. So that's a really big plus. So I would highlight style drift as kind of as you said, a no-no.
Right, right. And so what would be the most important slides that you hone in on in a pitch deck? Like what's the meat that you're the steak of it that you want to get to?
Um, you know, the manager's bio and track record, where they've been doing this. Like I mentioned, it could be at this shop, that exists right now for 15 years. It could be that this shop was formed last year, but we know what that manager did and how they did it, in the prior years. The track record, obviously, looking on a compounded basis is important, looking at 3-year, 5-year numbers, but also kind of the consistency of the track record. So was there one year that was a crazy, huge, return year that has carried, their 5-year numbers or something like that? That would be, less favorable to us than seeing more consistency to their returns. And also, you're right away going to look at the periods where they struggled. So when they were in a market environment that was not conducive for their particular strategy, how did they protect capital? Did they make their bad year be something where they were able to hang around the flat line? Or was their bad year, trending as far away from the flat line as it did in good years, on the upside? So, we'd love to see that asymmetry where managers know when markets are conducive to their strategy and they're able to, put the risk in the book and generate positive numbers, but also basically dial it back and potentially be a little defensive when they know the market is going the other way for their strategy.
I remember I came out of the CTA space myself
Mhm.
and was an asset raiser, and after 2008, every institution that I was in front of wanted to see a slide on risk management. That was like, oh, what's our risk management process? Like, we need to get that
Right.
together. That became a really big deal at that point. Maybe it's kind of common at this
No
point. But back
question.
then,
And that pressure led to, the significant rise in the managed account, concept. So, managed account platforms really rose. There was a lot of pressure after '08 and Madoff, and a lot of it stems from European investors first. And so at Purcell, one example, we had, nearly 50% of our assets while I was there on managed accounts. So you have the visibility into risk management. So, transparency of the process is key.
Right, right. That makes perfect sense. And so, without naming names, is there like a manager success story, like somebody that blew you away, like, wow, um, anybody that really impressed you according to how they've put
Sure.
together their operation?
I mean, not to give you a non-answer, but there've been many. I think that Longwall have looked, we've had, I think, about 125 manager meetings just in the past year, whether it be at conferences or, one-on-ones in their offices, or even, Zoom calls like yesterday. And so we've seen a lot of managers when you add up the years. I think that the success stories are, particularly in the emerging manager category, are the managers that not only, come out of the gate and start with strong performance records, but put the infrastructure and the right things in place to run their company, because it's very difficult to run a portfolio and a company at the same time. And I speak for experience as somebody that started a hedge fund. It's very difficult. So to me, a success story is a manager that is not only, generating good numbers and pursuing their strategy and has great risk management process and all that on the investment side, but has put the proper infrastructure, like I mentioned earlier, in place on the business and operational side, whether it be a CFO, a risk officer, operations, compliance, the whole thing. They're all very important, and it can be very distracting. So to me, the success stories are the managers that did both. They grew their assets to a threshold level with good performance, maybe new assets came in that were attracted by their performance, but they also built a company that's going to last, and you can see that it's going to last. It's built to last for a lot of years. As an example, at Longwall, we actually have a couple of family clients that also decided to become shareholders in our business. So I think it speaks volumes to kind of the partnership that, culture that we're looking to create with clients. And you really want to see that at a manager as well. You want to see a manager doing things that imply that he or she tends to be there for a long time and build an enduring business. Because obviously the hedge fund business is littered, with managers that were around for 3 years or less. And in many of the cases, Jennifer, as you know, it wasn't the majority of the cases, I think, were not necessarily performance related, but they're operational, and they didn't put the right things in place. So yes, I think that to me, the success stories are the managers that have put that infrastructure in place. They've outsourced to smart people around them those non-investment functions that lets them focus on the portfolio, because that's where our clients' money is, and that's what we care about having them do every day.
Right, right. Having working capital is essential, and
Yeah, which goes
a
back to the
runway.
concept of, which goes back to the discussion about, not trying to be a fee cutter to emerging managers, right? You want to partner with them. You make an investment hoping, obviously, that you're going to be in there for multiple years. So you care how this business does. And so, yes, I think that these things all kind of go hand in glove. And so, we do not focus on trying to be a price cutter. We'd rather focus on the manager, like you said, having enough capital to put these things in place.
Right. And so, what are you excited about for the rest of this year? What are trends or just things you're keeping an eye on in general? Could be in a macro sense or otherwise.
There's a lot to keep an eye on right now. Obviously the geopolitical. We've got more going on around the globe than we have in a while, unfortunately. Those can have an impact at any given moment, even on U.S. markets. The political, there's an election coming up, we're told. So that's that's kind of something that's hovering over the markets. And then just this general uncertainty that's been hanging around now for, a few months, about where inflation is really headed and what the interest rate cycle is going to be. So we have been of the mind that, interest rates would be, like I mentioned earlier, somewhat higher for longer. They're not going back to zero. And so it was a little baffling, the market reaction after Powell's comments on December 13th about, expected rate cuts, and the market kind of really ran with it, and there's a lot of euphoria. That has totally gone the other way now. If that was a risk that was in the market, of disappointment on when and how big we will get on the rate cut side, I think that's gone. There are people now, literally just as of this week, talking about might the next move be an interest rate hike. So that's a big deal. That's a big deal to the credit space. That is a big deal to small cap companies and really all growth companies that are, to some degree, their valuation, their PE multiple is really a function of interest rates, because it's discounted earnings, and growth companies obviously have, a lot of their big projected earnings out in the future. So, what happens here with the path of rates is absolutely, a focus for us. But again, we're not expecting a ton to happen anytime soon. There's obviously a lot of economic strength. So, we'd like to invest in areas, sectors, companies, managers that are able to take advantage of that economic strength, and or, are uncorrelated enough that regardless of what kind of market movement we get the rest of the year, they can deliver an attractive absolute return. Because it's going to be a choppy year. We're seeing it right now. We've just seen about a 5% drawdown in public stocks just in the past week or week and a half. I wouldn't be surprised. We would not be surprised at all to see several of those this year.
Right. And so how many allocations do you make in a year typically to fund managers?
It depends on how many, attractive managers you find that meet all your criteria. We're incredibly selective. I think so far we've made about 13 to 15 allocations. So we're not, spreading it really all around. We like to focus on kind of our best ideas. We run client portfolios that way to be, not, as they say, diversified or over diversified. And so on a manager selection basis, we're the same way. There's a hurdle you have to climb, that all those boxes, I've mentioned in the last few minutes. So it depends on how many managers come across, our radar screen that meet all those. It could be, 1 a quarter. It could be 3 a quarter. It's hard to say. And it's a function of, what we're interested in maybe tilting towards or investing in thematically, in terms of exposures we want for our client portfolios, and secondarily for, the fund we run internally. So it's hard to put an answer on it, but it's not, 15 a year. It's more selective than that.
Right. As it should be. You have to be careful.
I agree.
Yeah. Well, Terry, thank you so much for all of your insights. This is really, really helpful. I know that emerging managers are always kind of wanting to understand the allocation process and, best practices, what to do, what not to do. So I really appreciate your time today.
Absolutely. I appreciate you having me.